joining us for our ongoing webinar series, Financial Planning 101. And right now we are talking about investments and going to get into the basics today. And just as a reminder, every Friday we're sending out our Bear Facts Friday, and then we're going to be doing these webinars once every couple of weeks, just like we're doing today. So appreciate really everybody's time in being able to join us today. Last week we talked about the basics of financial planning, establishing an emergency fund, and today we're going to talk about the what, how, and why of investments.
Yeah, good afternoon, everyone. It's so great to see you again. We appreciate you tuning in. I think we've got everybody muted, but you might just want to double check to see if your camera is on or maybe if you want it to be on. So just double check on that. But just as a recap, what we're going through with our webinar series, which is every other Monday, is something that we call our financial success matrix. And so what that looks like is this pyramid right here. It includes three key areas: financial planning foundations, the investments, and then advanced planning strategies. And so in our first webinar, we talked about one of the most foundational pieces to any financial plan, which is an emergency fund, and we'll continue building on that next time. Today, as Kenny mentioned, we're going to get into the very, very basics of investments. And then with our next webinar, 2 weeks from now, we'll start on some initial advanced planning strategies. And so how we're going to go about this is just in a rotation. So we'll continue to build financial planning foundations, then investments, then advanced planning, and repeat from there on. So we appreciate your time.
Yeah, absolutely. Yeah, appreciate everybody being here, as I said before. So, I mean, today I think it's always great to get back into the basics. No matter how sophisticated you are, no matter how long you've been investing, no matter what you think you know, it's all on the building blocks. It's all built upon the fundamentals. It's like with any sport, anything in life, you don't start out as an expert. You got to be an expert at the fundamentals, and you build from there. So the first lesson to me is, why do you invest money? I mean, what's the point? We all want to have more money. We all say that. But ultimately, the real reason why anybody wants their money to grow is because you need to keep up with purchasing power. The simple explanation, as is illustrated in the slide, is that in 1918, so happens the year of the Spanish flu, there was a gallon of milk, or a quart of milk, I guess, cost you 14 cents. So for 14 cents, you could buy a quart of milk. And in 1968, you could buy 2 cups of milk for 14 cents. And now you're getting roughly 12 tablespoons of milk for 14 cents. It's just common sense tells you, or just life experiences tell you, that your money today does not buy you the same amount as your money, as the same dollar figure would have 10, 20, 30, 40 years ago. So you need to have that money grow so that your dollar today will buy you as much as a dollar years from now.
Yeah, and I think, Kenny, I think this makes sense. And not only, this perfect example of a quart of milk, but let's think about other things that it applies to, which is virtually everything. My granddad lived in the same house for 48 years, and he moved out not too long ago. But I remember him telling me the story that when they bought that house, they paid something like $42,000 or $44,000 for their house. You think about that nowadays, that might not get you a garage in your driveway. Right? Same thing with cars. A few decades ago, you could probably buy the nicest, newest car out there for maybe 20 grand. And today you go to the dealership and you could easily spend, 50,000 without even really thinking about it.
Of course. And that's why we have to have our money grow. I mean, a wealthy person in the 1940s probably had $100,000 to their name. I mean, and they would be considered very wealthy, what a millionaire is today. And if they just kept that money in the bank or kept it in cash, that person with $100,000 is not going to be able to buy near as much today in 2020 as they would in the 1940s, 50s, 60s, so on. It's,
that's so true.
Why we got to have our money working for us. And now, so the question is, how do we do that? what do we do? What do we put our money in so that it keeps up with inflation? Because certain investments are guaranteed to not keep up with inflation, whether it be putting your money in a CD, whether it be putting it in a money market account. Nowadays, essentially interest rates are virtually zero, and the safe guaranteed money that your money return on your money is going to be very close to zero, or certainly less than inflation, which is going to decrease your purchasing power over time. So there's a million things to invest in. We can invest in commodities, we can invest in cryptocurrencies, real estate, options, bonds, stocks, penny stocks, big company stocks like Coca-Cola, small company stocks that you've never heard of, private investments, hedge funds. You can buy and sell art online, or buy and sell vintage cars. There's literally unlimited options we have when it comes to investing our money and having that money grow. With those options, there's quite a different level of risk between investing in some privately held investment that somebody's got a great idea that's going to change the world, or buying Coca-Cola that's been around for over 100 years and has billions of dollars of revenue and income. There's a vast array. So I think, really, to me, this is something that is so often overlooked when it comes to just your average Joe out there. We all know these terms: stocks, and bonds. We all hear them every day, and most of us probably have a pretty good idea of what they are. But I think it's very helpful to just go back and explain from the beginning, what it actually is you're buying and why you may be willing to accept a certain level of risk.
And Kenny, let me jump in right there. But before you keep going, because I love where we're going with this, really starting at the bare bones basics. But for everybody who's joining us today, before we move forward, I want you to take just a couple seconds and either in your mind, or if you got a piece of paper in front of you, ask yourself to define what is a stock and what is a bond in your own words, right? And you don't have to share it with us or anything, but just take a couple seconds to think about, if we were to ask you, well, what is a stock? How would you answer that question? Same thing with a bond.
Mm-hmm. Yeah. So say that in your mind, and then I'll tell you, our definition, or what the definition of stock is ownership, right? Stock is equity. When you buy a share of stock, you own a piece of that company. What does that ownership give you? It gives you the right to the future cash flows of that business. What security does it have? It doesn't really have much at all, in the sense that equity ownership is you're not a creditor of the corporation, or if you are, you're way down on the list. So if I own a share of Coca-Cola, which comes to mind because it's right here in our neighborhood, then you have the right to the future cash flows of Coca-Cola. If something happens with Coke and all their products have been poisoned and they lose all their value, the company becomes worthless. Well, as an equity holder, you really don't have any right to anything. You could lose all your money. And you can see how, as an owner of a company, the volatility, or the up and down of that movement, changes every minute of every day. What are the future expected cash flows of a company like Coke? And they decreased rapidly when there was the COVID-19 outbreak, and when this came to light, that decreased the future expected cash flows. As things seem to settle in, maybe those future expected cash flows seem to grow, and that dollar, what that company is worth, is based upon that, and is going to change literally every second of every day. And in a company like Coca-Cola, there's a wide array of liquidity in public markets, where anybody, if I want to buy it, I can buy it at a moment's notice from someone selling, and if I want to sell, someone will buy it from me at a moment's notice. Total liquidity, total transparency, and it's money moving in and out of that company every day, and its value is changing literally every minute, every second of every day. A bond is loaning money. You are loaning money, and I'll use the same company, Coca-Cola. I'm going to loan my money to Coca-Cola, and Coca-Cola is going to pay me back a certain interest rate based upon the safety of that company and interest rates in the marketplace. So if I wanted to loan my money to Coca-Cola for 10 years time, they might right now, and this is a guess, so don't hold me to this, pay 3%. All right. If I give Coca-Cola $1,000, they're going to pay me back every year, $15 every 6 months, or pay me back $30 over the course of a year. And at the end of 10 years, they'll give me my $1,000 back. If in year 6 Coca-Cola goes bankrupt, the same example I used as a stock happens as a bond owner, and something happens and their drinks are all poisoned and the company becomes worthless, as a bondholder, you are still a creditor. So Coca-Cola has trucks, they have warehouses, they have their brand, they have their bottle making shop, they have a million different assets on their books. And when they are forced to sell those assets in a bankruptcy, you as a bondholder are standing there with your certificate and saying, I get some of this money. Now, will you get all your $1,000 back? Probably not, but you'll probably get darn close to it if if you're being a bondholder, a secured creditor of the corporation. So I think, Mark, you have anything to add to that as far as just what a stock is and what a bond is? I think it's always good to just revisit that from the beginning.
No, I mean, I love where you went with that, and truly, this is kind of the most basic understanding of it, but also the most important. And I love what we've done here. Think of it in this way because it rhymes and it's easy. But stock equals own, bond equals loan. And Kenny did a great job of describing what each of those are. And hopefully, for everyone listening, you kind of got your own understanding of how those work as well. Now, in the interest of trying to keep it, more elementary in this part 1 series, we're not going to go too deep at this point, but we will certainly going forward. But I think what makes sense now is let's get back to this idea which you've been describing of the riskiness of each. And so whether stocks, bonds, the rare artwork or any other type of investment, whatever the investment is, there is always, always, always that risk return trade-off. I mean, you can never shed it or avoid it or sneak around it. It's always going to be there. And that risk return trade-off comes in different shapes and sizes and forms. And so as investors, we have to analyze what is that risk return trade-off, and then what are we comfortable with accepting prior to choosing to make that investment. So one of the big things is understanding, well, if I'm going to invest in something, what's my long-term expected return? And I think it goes without saying that when it comes to investing, it's not a science. There's nothing guaranteed, and it's not a simple 2 + 2 = 4. But having said that, we can study the markets, and we have studied the markets to understand over a long period of time what should we expect. And let's kind of define what long period of time is. For you, you might be thinking, well, a long period of time is 2 or 3 years, or maybe 7 or 8 years. No, a long period of time, really, you've got to be thinking, 15, 20, 30 years. That's a long period of time. But that's kind of crazy to think about just in the terms of what our investment lifetime might look like, or what our specific time horizon may be. And so in addition to what we might expect over 15 or 30 years, we've also got to consider, well, what's the short-term volatility, right? Because the volatility tells us much more about what we've got to deal with day in and day out, particularly when we're talking about the publicly traded markets and investing in stocks and bonds. And we'll get a little bit deeper into this, but what other risk return trade-offs do you think exist out there, Kenny?
Yeah, I mean, I think it's just, it boils down to, and just if people can get this in their mind and take it truly to heart, then they will have such a better investment experience over their lives. And it's essentially, there is no free lunch.
Mm-hmm.
It's very easy to look backwards and say, I should have, I knew that was a good deal. I knew they were going to get the approval on that drug. I knew that, Apple was always going to be, the leader in technology and phones and iPads and,
Or how about I knew that the market was going to have a pullback. It just had to happen, and sure enough, I predicted coronavirus.
Of course. Yeah.
Yeah.
I mean, yeah, we hear that too. I mean, I think so the takeaway is that there just is not a free lunch. There, for any reward you get, you have to accept the risk associated with that. And whether it is these, to me, like boiling down what Mark has up there, pretty much sums it up, is these are the risks. You either time your money up so you limit the liquidity and you can't access the money, and you do that for either guaranteed safety, right? If I buy an annuity, I know that I will guarantee have my money back in a deferred annuity in 5 years. But if I want my money in year 3, I am going to actually pay a penalty and have a negative return. The same goes with the CD. CDs are the exact same. So I have a guarantee of safety, but I give up liquidity, right? So if you want anything more than what is currently the risk-free rate of return, which is T-bills, which is 0, then you give up something to get something. Stocks, right? You don't give up liquidity. You can get your money out the next day in Coca-Cola, or you know, T minus 3 days with individual securities as far as settlement. That's kind of the next step. But you can sell and you can get your money. Mutual funds, you can sell and you can get your money the next day. What do you give up? You give up that guarantee of the money going to be there, that the money will be there. The money's going to go up and down consistently every second of every day. So, you know, that's what you give up. The short-term volatility, and you give that up for the higher expected reward over time. And that's just something to always be thinking about, that if you expect to get a return, a good return, you've got to be willing to accept the risk associated with that. And sometimes that risk means you will never get your money. You might lose all of it. Or it may be that 30 years from now, your money could be worth 20% less than what it is today. And that happens a lot, you know, with individual securities. That is the risk, but you accept that risk so that in 30 years, if you buy a stock, it could be worth 20 times what it is today. And that's the risk reward trade-off.
Yeah. Yeah. So let's talk about these ideas when we talk about the market or think about it. This idea of what has happened versus maybe how people more so think of it, what is happening, right? That you might think, and we hear it all the time. Well, you know, I'm getting 6% return on my investments. And this isn't just to kind of be, you know, ticky tack on certain things, but that's a really wrong way of thinking about it, quite frankly. You're not ever getting anything. It's what you have gotten, right?
Absolutely. I mean, when we hear that all the time, and I'm sure some of you on this webinar think that way. I'm getting 14% of my 401k. I'm getting, you know, after a year like last year, I'm getting 25%. And that just is, I mean, factually incorrect. You have gotten that. If you were getting that on a continuous basis, well, I tell you, sign me up because anybody would jump at that chance. Just as right now, if you know the market's down 12 or 13% for the year, you're not getting a negative 13% return. That's what has happened. And the unfortunate part is, and this is in every investment in prospectus or anything that's laid out in front of you, and we gloss over it, but it's in there for a reason. It's that past performance is not indicative of future results. And it says that because it is so true. Because the market has a negative return of, you know, upwards of 35% at one point, does not mean that that's what's going to continue to happen for the next 6 months. Just as if last year it was up, you know, 30%, does not by no means mean that it's going to continue to perform that way moving forward. The
Yeah,
market,
I think this is where we a lot of times encounter, you know, people might think of this idea of what you're getting versus what you have gotten in the markets in the same way that they might think of analyzing, let's say, a real estate investment, where, hey, I know if I put X% down and, you know, I'm running the pro forma calculations with my cap rates, et cetera, then I might get, you know, 9% ROI. And assuming everything stays constant, your rent rolls and your vacancies and your expenses and everything, you can calculate out what you would get, right? But
Yeah.
thinking back to our prior slide, well, what is that risk return trade-off there? In that case, your risk return trade-off is illiquidity because you're in that real estate investment. You can't just go out to TD Ameritrade or Schwab or anything else and just click the buy or sell button at any moment's notice, right? So that is a perfect example of the differences here that we're talking about. And then going, a little bit next step with this is that the market is forward looking, right? So when we see prices today, and when you see what's happening either today or what happened yesterday, the market is constantly pricing in new information every moment of every single day. And so when we see that a drastic decline has quickly happened like it did recently, it's because the market is pricing in those future cash flows being impacted, like Kenny was talking about earlier. Yeah. And so the idea that you could maybe time it or beat it or get it on the front end, we've seen just time and time again that doesn't really play out how most people would hope that it does.
Right. The market makes, when you break it down, it makes a lot of sense. And I think if people thought about it in the ways that it actually works, would be more comfortable understanding, understanding investments and why you make investments and so forth. An example I would give is look, people have asked us during this, during this crisis, well, shouldn't I buy Clorox? Shouldn't I buy, what other cleaning supply companies or companies that are providing consumer toilet paper, of course. And the answer to that is the market is not dumb. They have priced in the expected growth of the companies that are specializing in those areas: food delivery, toilet paper, cleaning supplies. It's not that the market just is set there with its blinders on and doesn't know what's happening in the rest of the world regarding coronavirus. All that knowledge in the world goes into what is pricing that stock today. And the price of that stock today has to do with what the future outlook of that particular company is. And when you price that in, right, it just tells you common sense tells you that I don't have just a free lunch by investing in something that I already know is going to perform pretty well over the coming months because of the current crisis. The way to do that, the way to have gotten that outperformance would of course been to know on the front end this was going to happen, and before all of the knowledge in the universe went into putting the price of the stock that incorporated what's happening in coronavirus and COVID-19 and this global pandemic, it would have been to buy it before all that information went into it. And we didn't know that. And so you can't do that. That's why there isn't, it's no free lunch. Just as the same as it's no free lunch right now. I know I'm kind of rambling, but just because we get the two opposite ends of the spectrum, right? People want to come in and they want to buy Clorox and the cleaning supplies. Well, those have already run up tremendously, and those future expected growths are priced in. And then on the opposite side, they want to buy airliners. They want to buy cruise liners or the cruise companies. And the opposites, the same is true there. Those future expected cash flows have decreased just rapidly, and since we've seen 70, 80, 90% decline in some of the airline prices. And there's a reason. It's not a free lunch knowing that, the airlines, when then we get out of this, are just going to come straight back. They could be taken through bankruptcy. You could put your money in there. It's happened with Delta not that long ago, and you could lose everything you have. Now, you have a much higher expected return when you put your money in today into those companies, but you also have a lot higher risk because we don't know what this is going to look like when we come out on the other side of that. And those are sort of the two opposite ends of the spectrums. The companies we know are going to take huge advantage of this, sort of crisis that we have at hand now, and the companies that have just been eaten alive by it. And
Yeah.
there's, all of the information is priced into what they call both of them today.
So I think that's a good segue into this, what does it take, and how do we go about it to get to that end game with the risk and reward that we're talking about. If we look back over the last 50 years from 1969 through 2018, let's look at exactly what we've been talking about and what does it take to get there. Inflation over that time period has actually been right at 4%. There was a period where inflation was very high, as you might remember. And historically, over time, it's closer to 2.5%. But for this time period, it's 4. And so what that means is that if you had put $1 in the market, if $1 in 1969, all by itself would be worth about $7 today, just purely based on inflation, right? Doing absolutely nothing. And if we look at, well, what would be, giving me something that's a little bit better return than inflation, but with very minimal risk, well, it would be T-bills. Over this same time period, they've returned 4.7%. And so that difference is, if you put in $1 back in 1969, it'd be worth right about $10 today, right? And this little squiggly line represents that risk return trade-off that we've been talking about. It's a little bit up and down, but not too much short-term volatility. You expect that there is going to be price movement. We know that that's going to happen, but it's not going to be these wild swings typically. And then let's take it one step further, because T-bills, representing bonds over and above inflation, they give us some return, but you might argue, and rightfully so, that that's probably not going to be enough to make your money truly last or grow to keep up with your purchasing needs and purchasing power. So let's look at what the S&P 500 has done over that time period. It's returned 9.8%. And the S&P 500, you might know, represents the 500 largest companies here just in the US market. It's one of the very common market indexes. We're going to get into market indexes actually next time. But this is what most people might think of when they hear or say the market, right? So that difference between 4.7% and 9.8%, what do you think it might be? It's actually drastic, right? $1 back in 1969 at 9.8% compounded return is worth $107 today. I want you to ask yourself, is that surprising, or does that kind of fit in line with what you might expect based on the two lower bars there with inflation and with T-bills? Now, the main thing that we need to talk about on this chart is, here again, what does it take? This red line. This is what it takes to get that overall long-term return. And it's obviously just a little hand drawing. It's not to scale, we'll say, but it is in fact true that to get this greater return that the S&P 500 has given over the last 50 years, you've had to stomach some, incredibly painful times. One, like exactly right now, right? There's been some drastic swings up and down, but if we've got the right mindset and the right strategy and the right time horizon, you've been rewarded accordingly.
Yeah. I think it's so easy to gloss over a chart like this. I wrote an article, hopefully some of y'all have seen it. It was probably 2-3 years ago now, but about a janitor janitor who ended up dying with like $20 million that he gave to his local hospital and his charity. He never made more than $25,000 a year. And the point of the article was, that's amazing. And everybody wrote these articles about, wow, how incredible this guy who made, relatively speaking, a low income was able to pass on this, unbelievable amounts of wealth to his local hospital and library. And what I went back and illustrated was truly the pain that the man had to go through to get that reward. Because it's so easy to sit here and look at it. If you invest $10,000 a year, in 30 years, you have XYZ dollars at 10% return. But it's one thing, well, when the guy had $7 million and then it went to 3.5 because of, the dot-com crash. And then he had $14 million and it went to $9 million, he lost more money than he'd ever made in his lifetime over a 12-month period. But he ended up with that because he had the discipline and he could take the pain. So every one of those red squiggly lines in real life can illustrate years. We're sitting here today and having this conversation, and sometimes, the days are very long and the years go by fast. But when we look back at that, it's easy to gloss over. But when we put ourselves back in that, well, it could have been 3 years' time that the guy had invested, lost half of his portfolio, and it just started to come back 3 years after. In 3 years on a chart, looking back to 1969, if we're talking between 1979 and 1982 as an example, that's no big deal. But when it's 1979, it feels like it's going to take a long time, and stocks aren't the place to invest, and I knew I should have moved out, and yada, yada. It's just human nature. There's nothing wrong with it. It's just simply, how people think. We all want to be rewarded without having to accept that pain. And the truth is just it doesn't happen that way. Anything worth it, you've got to go through the process and be disciplined to handle the bad to ultimately get the good.
Yeah, no, that's so true. Couldn't have been better said. And I think, in the interest of time, we're bumping right up against 30 minutes. This is a great kind of segue into what you can expect from our next investments webinar, which, as a reminder, we're doing a rotation, so it won't be for a couple of weeks, but we're going to continue to explore this idea of what is the market. We talked about the S&P 500, but that's certainly not it. That represents 500 companies out of a total of about 12,000 publicly traded companies across the globe. We're also going to take a deeper dive into asset allocation. So, what does your specific strategy look like, and how should it look relative to things like your time horizon and how much capacity for risk can you take, and what can you really stomach? And then we'll talk about other things like how to invest and what are mutual funds and ETFs and all these other things that go into investments.
Right. Yeah. I mean, more, just getting deeper, understanding what those are. I think hopefully most people have some idea, but then what should you use? Should you buy individual stocks? Should you buy mutual funds? Should you buy ETFs? And then explaining why and how at least we believe it should be done. I wanted to address, we got a question about how is long-term strategy affected when you want more short-term benefits in order to live a little now. And I don't know how to take that question exactly, but I think it boils down to this. Anytime you're looking for a short-term benefit of an investment, if you're trying to invest in something today and in 3 weeks you want it to be worth 3 times as much, that, in my opinion, and I think most people's who do what we do's opinion is that's not an investment. That is a gamble. Mm-hmm. Investing, my favorite quote when it comes to investing is by Paul Samuelson. He won a Nobel Prize in economics, and it goes like this: investing should be like watching paint dry or watching grass grow. If you want excitement, you should take $800 and go to Las Vegas. I mean, you buy Coca-Cola as an example because you expect the growth of that company over the next 10, 15, 20, 30 years to continue to be the great company that it's been for the previous 100. They're going to open up in new markets. They're going to come out with new products. They're going to purchase other competitors and market their products even better. They're going to continue with their bottling and so for the next 20, 30, 40, 50 years. What they're going to do in 6 weeks is literally anyone's guess. I mean, that is not an investment. So anytime, that's just the thing. In hindsight, we could have been at the bottom and Coca-Cola could shoot right up and we could look back 6 weeks from now and say, that was a great, what a great investment. But really, it's not investing when you're looking for any short-term reward. You're just, it's not investing. It's gambling. It's speculating. It's, there's no meat behind it.
Well, perfect example, just real quick. Let's say you were starting out investing and you happen to start on, March 1st. Within a very short period of time, you could have been down 30+%. Let's say just by happenstance or luck or whatever the case may be, you didn't get into the market instead of March 1st, it was March, 23rd. 24th, really, you could be up 20% right now. So
Yeah.
I think you said it perfectly. Anything where you're just trying to make a quick buck, that truly is gambling. That's not investing. But I encourage you to tune in next time, because that really does get into asset allocation. How should my strategy be set up to give me that biggest return for the risk that I'm willing to take, right?
Absolutely. That is kind of level two, which we will talk about next time we get back to investments. And then another question is about what factors are looked at when you recommend that a portfolio not be changed during times like these. And I think what really the question is asking is, do you just make wholesale changes to a portfolio based upon, quote, times like these? And the answer is you do make changes around the edges. All right. You do rebalance. So if you have stocks and stocks have done terrible and bonds have done great, you sell the bonds, you bring the stocks back. So you have equal weighting you have the same level of risk that you had before you went into the crisis. That's an example of rebalancing. But what you don't do is wholesale change the risk. I'm a real risky investor last year, but now in middle of March of this year, I'm a conservative investor because of COVID-19. That is what you just can't do, and that is where you take what are really pretty predictable results. And I can tell you that today, looking 10 years out in the market and how we invest, I feel pretty darn comfortable that most anybody who looks back at it, if you're a conservative investor today, in 10 years, if I look at your portfolio and it's remained conservative all along the line, you'll be happy, right? You probably won't have as much money as an aggressive investor who starts here and remains aggressive the whole time through 10 years, but you'll have less up and down. It'll be a smoother ride. But I can reliably, predict you'll be very happy with your result there. If I look at your portfolio today and you're conservative, and I look 4 years now and you're aggressive, and I look 3 years after that and you're back to conservative, I literally have no idea what your result would be. And I would be much more apt to say you probably will be unhappy, most likely. Now, you could get it right. You could be conservative right at the top of the market and aggressive right at the bottom. Absolutely. It's possible. There's no studies to suggest that you're able to do that consistently. And there's no evidence to suggest that. There's not been anybody to come out with something that's been proven to say this is when to get in the market, this is when to get out of the market. And there have been people trying for many, many years to do as such. But it's possible. But the likelihood is that if I look at your portfolio 10 years from now and you're conservative today and you're aggressive then, or vice versa, you're probably going to be very unhappy with the result, and you change the level of predictability entirely. I don't know what that looks like. Maybe it looks unbelievably great, and maybe it looks unbelievably bad, but we just have no idea as to where we can predict, as long as you're disciplined and stay the course, at least as relative to your risk profile. That makes sense, hopefully.
Yeah, those are great questions. We appreciate everybody tuning in. And if you have any additional questions, shoot us an email. Let us know, and we'll be sure to address them not only with you, but hey, maybe even on a future webinar, or also maybe on a future Bearfax Friday. So we appreciate everybody tuning in today. If you were not available to view this live, it'll be up on our website later today, and we look forward to seeing you for our next webinar. Thanks so much.
Yeah, just quickly, I would just add that. So if anybody wants to call us directly, you know where to reach us. We are happy to have a one-on-one meeting with anybody, via Zoom or just a phone call. And then if any of your loved ones, anyone out there just want a second opinion about what they're doing and just, am I okay? We're here for them. And we're here to absolutely offer a complimentary second opinion to at least point people in the right direction. So don't ever hesitate to have anybody reach out.
Yeah.
All right, y'all. Have a great rest of the week.